Most people will never build real wealth from investing. Not because the market is unfair, not because they started too late, not because they did not have enough capital, because they never had a framework. Welcome to the ProfitByFriday.com podcast, where we replace guessing with process, emotion with discipline, and noise with one clear idea every single week. Let us get into it. In episode 1, I introduced the 5 questions every investor must answer before buying any stock. The first question was the most important one. What is the specific reason this stock is going to be worth more in 3 years than it is today? If you cannot name it in one sentence, you do not have a reason. You have a feeling. Today we go deep on that question, because finding a real catalyst before a stock moves is the single most valuable skill a retail investor can develop, and almost nobody is doing it correctly. Here is the problem most investors have with catalysts. They confuse themes with catalysts. They hear that artificial intelligence is changing everything, and they buy every stock with AI in the press release. They'll hear that electric vehicles are the future, and they buy every company making batteries. They hear that the population is aging, and they buy healthcare stocks broadly. Those are themes. A theme is a direction. A catalyst is a specific engine driving a specific business forward at a specific rate. The difference between the two is the difference between a guess and a thesis. Let me show you exactly what a real catalyst looks like. A real catalyst is structural. It is built into the business model in a way that does not depend on the news cycle, the macro environment, or what the broader market is doing. It exists regardless of what the Federal Reserve does next quarter. It compounds regardless of whether the economy is growing or contracting. Here are 3 types of structural catalysts worth understanding. The first is pricing power. A business that can raise prices every year without losing customers has a structural catalyst built in. Every price increase flows almost entirely to the bottom line because the cost to serve the customer does not rise proportionally. Over 10 years, a business that raises prices 3% annually in a market where customers have no real alternative compounds dramatically. This is not a story. This is math. When you find a business with genuine pricing power, you have found a structural catalyst that works silently in the background every single year. The second is a regulatory moat. Some businesses operate in industries where regulation creates a permanent barrier to new competition. The cost and time required to get regulatory approval is so high that new entrants simply cannot compete on equal terms. The existing business captures the market and holds it. This is not about being protected from competition forever. It is about having a structural advantage that takes years for competitors to overcome. That gap is the catalyst. The third is switching costs. Some businesses are so deeply embedded in their customers' operations that switching to a competitor is not just expensive, it is operationally dangerous. Enterprise software is the classic example. When a company has been running on the same platform for 10 years, the cost of switching is not just the software license. It is the retraining, the data migration, the workflow disruption, and the risk of something going wrong during the transition. That friction is a structural catalyst. It keeps revenue sticky, reduces churn, and allows the business to raise prices without losing customers. Now here's how you verify a catalyst before you invest. Step 1. Name it in one sentence. If you cannot summarize the specific reason this business is going to be worth more in 3 years in a single clear sentence, keep working. Vagueness at this stage means you have not found the real catalyst yet. Step 2. Find the evidence in the numbers. A real catalyst shows up in the financials before it shows up in the stock price. Rising gross margins signal pricing power. Declining customer acquisition costs signal switching costs deepening. Revenue growing faster than the market signals a regulatory moat widening. If you cannot find the catalyst in the numbers, be skeptical of the story. Step 3. Test the durability. Ask yourself how this catalyst performs in a downturn. Does pricing power hold when customers are cutting budgets? Do switching costs remain high when procurement teams are under pressure to find cheaper alternatives? Does the regulatory moat still protect the business if the regulatory environment shifts? A catalyst that only works in a bull market is not structural. It is cyclical. And cyclical is not what we are building around. Step 4. Check who else knows. If the catalyst is already on the front page of every financial publication, the stock price has likely already moved to reflect it. The most valuable catalysts are the ones that are real, verifiable, and not yet fully understood by the broader market. This is where deep reading of quarterly earnings transcripts, industry reports, and regulatory filings pays off. You are not looking for insider information. You are looking for publicly available information that requires more effort to find than most investors are willing to put in. When you apply all 4 steps to a stock and the catalyst holds up, you have the foundation of a high-conviction position. Not a tip, not a feeling. A specific, verifiable, durable reason why this business is going to be worth significantly more in 3 years than it is today. That is the catalyst pillar of the clear framework. And it is the gate every stock must pass before anything else matters. Amateurs buy stories. Investors build around catalysts. The difference is one sentence that holds up under scrutiny. Go to ProfitByFriday.com for more. I will see you in episode 3.